introduced some defense of the Austrian economists, because on money and credit, the Austrian economists saw this crisis coming for literally years. Okay, they saw the growth of the money supply that I showed you, and they saw the natural consequences of it. Whereas the Keynesians and a lot of the experts in government, they didn't see it coming. And of course, they're the ones that are telling you now that it's gone. So what has happened, though, could not have happened without the cooperation of big capital and big government. You know, as in the civil state. The bank failures, they had their roots in unchecked credit creation with the Federal Reserve. The Fed just kept pouring money into the system without a corresponding growth in the real economy. So, and that was under Alan Greenspan. He came on in 1987. There were changes made in the regulatory structure under the Clinton administration, under the Bush administration, that created a lot of problems. So, Treasury Secretary Rubin, Larry Summers, and they're now both part of Obama's team, and these guys really put things in place that created the problems we have in the banking system. So, regulatory liberalization, at the behest of the largest firms, and neglect continued all through the Bush administration, and it's a bipartisan crisis. The idea that this is, a Democratic or Republican crisis is just hooey. So during the Clinton administration, actually November 12, 1999, the Glass-Steagall Act of 1933 was repealed with the passing of the Gramm-Leach-Bliley Act. The Glass-Steagall Act it separated commercial banking and taking deposits and making loans from investment banking. The banks were to be run somewhat like public utilities, pretty boring. The bankers came at 9 to 5, they earned interest, it was pretty dull. Yet the investment banks, they do the underwriting of bonds, stocks, and so forth. The Glass-Steagall Act, it grew out of the Pecora Commission, which was it was a congressional commission that happened in the 30s after the great big crash. Now, any of you that want to learn about economics and economic history, I cannot say enough about Henry Peilu. He's a Chinese national, Harvard educated. He writes in Asia Times, and he is just, he's nothing short of brilliant. I don't agree with everything he says, but when it comes to economic history, he's just fabulous. I'm going to give you some, pretty extensive quotes from him, and I apologize for the long quotes, but it's so well written, and it explains what happened so well that why reinvent the wheel. So here, this is about the Pecora Commission and the Glass-Steagall Act and what happened. And the Gramm-Leach-Bliley Act. Okay, the new Democratic chairman of the Senate Banking and Currency Committee, Senator Duncan U. Fletcher of Florida, immediately dismissed the Republican General Counsel of the Commission on the 1929 crash and appointed as a replacement Ferdinand Pecora, an assistant attorney for New York, known thereafter as the Pecora Commission. Its new investigation after 1930 revealed a host of conflicts of interest in the financial sector in the years leading up to the 1929 crash, such as bank underwriting of unsound securities to save non-near performing bank loans. So they put up a bond to pay off the bank loan because they knew the loan was no good. Rampant insider trading pool operations by speculators, banding together to move a stock and close out the pool at a peak price for profit, leaving the manipulated public with subsequent losses. More shocking still, the Pecora Commission uncovered the embarrassing fact that J.P. Morgan and his fellow banking titans not only continued to reap huge profits from rescuing firms that helped put into distress while the economy fell into the Depression, they were also able to avoid paying taxes on any income tax in 31 and 32 through tax loopholes on paper losses of the distressed companies they acquired. These bankers were in fact buying up a country in economic distress with the tax deductions. Imagine that. So They put a company in, they'd lend a company money, then they'd pull the loan back, then the company would be in distress, then they would buy the company, get the assets, and then they would use the tax losses to offset income from other places. This is going on again. Now, ironically, another Democratic president, here Henry Lou, another Democratic president elected on a populist platform in 1992, another 3 decades later, repealed in 1999 the Glass-Steagall Act that had created the SEC as the Securities Exchange Commission. The Frontline program of public television produced a documentary dealing with the role of the Clinton administration in the long demise of Glass-Steagall. On February 12, 1999, Clinton signed into law the Graham-Leach-Bliley Financial Services Modernization Act, which repealed the Glass-Steagall Act to allow commercial and investment banks to reconsolidate. The repeal of the Glass-Steagall Act, by combining the conflicting roles of lending institutions and security issuing institutions, facilitated the development of structured finance and debt securitization that contributed structurally to the 2007 debt crisis. Another quote from Henry. On Black Monday, 1987, Alan Greenspan, newly appointed as chairman of the Fed that year by President Reagan, bought Friedman's liquidity fallacy wholesale. He issued a one-sentence statement at 8:41 a.m. on Tuesday, October 20th, 49 minutes after the markets opened at 9:30 a.m. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial systems. So, you ever hear of the Greenspan put? Nobody? Okay. The Greenspan put was after he had made that announcement that as much liquidity as necessarily would be required. People, investors and speculators assumed that Greenspan and the Federal Reserve would always come to the rescue to provide as much money as was necessary. And it opened up the doors to speculation. And speculation is really what got us in trouble. Now we've ended the barrier between banks and savings banks, take deposit loans, and investment banks that do stocks, bonds, and so forth. So that was one thing that we knocked down. The next thing, there were capital requirements. Okay, and the idea of capital requirement is something like a down payment on a house. You have to have a certain amount down so that if the house was down in value or you were making payments, the bank can recover. Well, in 1975, the Securities and Exchange Commission, they created a rule, just a simple ratio, that a broker-dealer that do stock and bonds, for every $12 they borrowed, they had to have at least $1 of capital. So to use the house example, if you put 10% down and the house went down 7%, if the bank took over the house, they'd be able to recover their loan. Now, in the old days, when broker-dealers went below this 12-to-1 ratio, they were merged or closed by the SEC. And I'm going to go back to Henry Lou again. He writes in an article called, and this article is just, he wrote September 11th, 2009. He says, why the bank vaults are empty, excuse me,